All right, hello everybody, and welcome to the very first edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and I'm joined today by Derrick Oldensmith. Derrick is the senior trader at T3 Trading Group and the leader of the Pro Desk virtual trading floor. Hi, Derrick. Thank you so much for joining us today.
Greta, I'm pumped to be here for this, I believe, is the first ever Conversations with a Pro Trader.
Yeah, you are the guinea pig, if you want to say,
I'm happy to be the guinea pig.
All right, so before we get into everything here, we do need to show some disclosures here. So I'm just going to pull those up for 5 seconds. This is just something we have to do as part of a trading firm, just to cover all of our bases. But as I mentioned, Derrick is the senior trader at T3 Trading Group. So he is a professional trader. He does this day in and day out every single day. So my first question for you today, Derrick, is going to be, how long have you been a trader?
Sure. So I started my trading career in 2008 as a sales trader for a different company. I did that for a couple years. Wasn't really my cup of tea. I ended up moving into prop trading and joining T3 specifically in 2010. So I'm working towards my 13th anniversary as a prop trader here at the company.
All right. Okay. So everyone, now you kind of know who Derrick is, how long he's been with the company, what qualifies him to talk to us as a professional trader. So Derrick, let's get right into it. If you had to give your week of trading so far a grade, what would that be?
So I've traded really well this week and so far this year, to be totally honest with you. I always try to keep everything fair and balanced. I am like not God's gift to trading. I am wrong all the time. It just happens to be that I've kind of been on fire recently. I had a great day today. I had a great month last month. So honestly, if I had to give my trading this week a grade, it would really be an A plus.
All right, an A plus. That's not bad. But like you mentioned, every week is not like that. And as we get through these events and we host these more, there's going to be plenty of bad weeks, I'm sure, that Derrick and I will be talking through as
It's
we
part
move
of the
on.
game. If
Yeah.
you don't have bad days, bad weeks, bad trades, you haven't been trading long enough. It will happen, I promise.
Definitely. Okay, so today was arguably the biggest day for Wall Street so far in 2023. This morning, we got the private jobs data from ADP for the month of January. The Fed decision, as we all know, was today at 2 p.m. Eastern, and then earnings season is continuing to pick up as well. So what was your strategy as you were going into today's session?
Sure. So first of all, today was completely insane. In an awesome way. I mean, the market was just so strong off of the Fed meeting at 2 o'clock today, and we've broken some really key levels both today and kind of coming into this trading session. So things are looking pretty good for bulls right now, at least as of today's close. My strategy as far as today goes. So I guess we need to talk a little bit more about what my strategy is broadly when it comes to trading. So
Right.
I combine day trading and swing trading. And I also combine a quantitative approach that I have kind of developed for myself over the years. So I'm doing all that at the same time. I will very regularly have swing positions on that I'll keep for weeks, months, or even years. And I very actively day trade around those core swing positions for cash flow each day. So that's a big part of what I'm doing. So coming into today, the game plan was for positions that I already have open, just continue to monitor them and follow the game plan that's already been established before I got into those trades. And as far as new positions, a day like today, I want to be careful coming into this trading session. Honestly, even this entire week, I've been a little bit careful. We've had a really big move in the market over the course of the month of January, and now it's February 1st. I've performed really well in that move. I've been very heavily to the long side personally for most of it, kind of trimming and trilling on the way up. I was kind of going into a mode of wanting to preserve those profits for this week, knowing that we have so much coming up on the horizon. Now, I'm not going to just liquidate my long positions and get out of them entirely, but I didn't really want to be too aggressive this week on doing anything new. So a few good day trades almost every day this week, including this morning on one of those AI plays. The AI plays have been really hot recently with the whole chat GPT and what's going on with Microsoft there. So cool little day trade in that this morning. But really the plan was to not be too aggressive. And especially I have found on Fed days, after the open, so after the first hour, between like 10:30 and 2, when the Fed announcement hits, one of the best things you can do on Fed days midday is just sit on your hands. The price action is usually very choppy. Anybody that wanted to make bets that are going to move the market based on the Fed, they've already done so. So the worst thing you could do for yourself on a day like today is overtrade prior to the announcement. So it was really all about preserving capital and then seeing what happens at 2:00. And then 2:00 is really where the fireworks happened. Our expectation, and this was just based off of recent Fed meetings for the year of 2022, was with the announcement at 2:00 to get a lot of market volatility, but no direction. And we figured that if there would be a directional move, it would actually come from Jerome Powell's press conference, which would begin at 2:30. So first of all, from a personal circumstance, if you want me to get into this, I had the wonderful experience of breaking my cell phone today, like a couple hours before the Fed meeting. And one of my roles here at T3, one of my many roles, is that I'm also the director of business development for our equity and equity options team for T3 Trading Group. So I can't not have a phone. So that was a complete disaster. I went downstairs to make a cup of tea. I basically bent over to pick something up, and my phone fell like 6 or 8 inches onto a hard floor and was just, it was just screen was shattered. It was done. And I was like, oh my God, this can't be happening right in front of the Fed meeting, right as I'm about to be doing, conversations with a pro trader with Greta later today. This can't possibly be happening. So I had to drive, I'm in Idaho right now. I had to drive to Jackson, Wyoming to get my phone fixed, like over the Jackson Pass, which was crazy and icy to get over there. And I brought a laptop with me. I brought an extra monitor with me. So I'm at the place getting my phone fixed, setting up my trading setup. I was upset because I didn't have a microphone. I couldn't talk to my traders as the number dropped to 2:00. But now I'm sitting there trading while the guy's fixing my phone. He tells me my phone is fixed, like at probably like 2:15 Eastern. So I had 15 minutes, but it's a 45-minute drive to get back to my place. So I was like, oh man, what do I do? Like, do I just stay here and just trade the rest of the trading session from this little repair shop in Jackson, Wyoming, or do I really try to make a beeline, back to the place where I'm staying in Idaho and kind of trade, the close? So honestly, you were the biggest decision maker in that, because I knew I needed, if I stayed in Jackson, Wyoming and traded there until the close, I wasn't sure that I was going to make it for this podcast or whatever we're calling it. So I made the mad dash back over the Jackson Pass. I got back here at maybe like 2:45, 2:50. It was just as the spies were getting to 410. And I was like, oh, well, that's really interesting. Big move to the upside here. I don't even know what Jerome Powell has said. I had to go back and catch up on all my research. But I was like, all right, I think this is a great spot to book some profit. And then a little bit after that, when the market continued a little further, we started to hit that point technically with the market where we start to stretch out enough that we struggle to get real continuation. And I started shorting a little TQQQ to kind of hedge my remaining positions that I had on. And then I caught up on everything. So, really, really interesting day. Do you want me to, do you have questions for me about the Fed, or should I just keep rambling about it? Because I can keep going on and on and on about that like today.
All right. Okay. So you talked about it. We saw a huge turnaround in the market today after that Fed decision. But really specifically, it was after Powell's presser. And that's kind of how it's been lately. Everyone knows what the Fed's pretty much going to do. The rate hike is not a surprise, but it's what Powell says that everyone is focused on. So you talked about, what you did afterward and how you got back to it. But the big thing that Powell said today was, let me get to it. The big quote was, we can now say for the first time that the disinflationary process has started. So what does that signal to you about the Fed's future plans and what the market is trying to kind of get out of what he said today?
Sure. So it seemed pretty obvious to me, if you've been looking at the numbers, that disinflation has already begun in at least certain areas of the economy. It's the fact that he said it is what makes the big difference. So whenever we're looking at these types of events, it's not just what happens and what is said, it's what happens and what is said versus what the market expects. So everyone knew pretty much at this point that it was going to be a 25 basis point hike. So when that gets announced, the market really didn't do anything. We just chopped around and went sideways. It's what you said is when you start to speak, particularly the fact that he kept referencing on multiple occasions this idea that disinflation has started to come. And he's also mentioning something for housing and services, which has been the stickier part of inflation, that we understand that there's a lag on our actions to when it really hits this part of the economy. And we expect disinflation to begin to hit the housing market soon, which again, that's been kind of the bigger, stickier portion of inflation that they need to tamper down. So the market ate that up, loved it. Again, it seemed very obvious to me that disinflation, particularly with goods, has already been happening. It's the fact that he used the words because it's a little bit more of dovish type language that really totally set this market up and ripped the market higher. There are a few things I'm still trying to figure out that are puzzling me a little bit. So the market, the Fed funds futures are still pricing in 50 basis points of cuts in the second half of the year. And that's the part that that's obviously bullish for the equity markets. I'm still struggling to fully wrap my head around that because Powell's giving zero indication of that.
Right.
He's still saying, yeah, eventually we're going to pause, but when we pause, we're staying there. I think he even literally said today, I don't see us cutting rates unless there's like a real emergency situation or unless something really major happens that we're not expecting. I think that they want to stay at that rate. He's going to be very fearful, just looking back at history, he's going to be very fearful that if he were to begin to cut too early, you could get a second boost of inflation that could be even more difficult to bring down. So, and at the same time, the only way that you would really be able to get cuts in the back half of the year is if either inflation comes down massively or we're really going into a recession and they're forced to. But at the same time, there's been all this chatter about, hard landing, soft landing. He basically said today, maybe no recession. So how are you going to expect the Fed to cut this 50 basis points in the second half of the year if we're not going into a recession? So that's the one thing I'm still trying to figure out. But whenever you've got a difference between what the market thinks and what someone says, in this case, the Fed chief Jerome Powell, I'm always going to assume that the market is right until proven otherwise. And I think that that's a best practice in general as traders. Assume that the market is right. We're not smarter than what the market is. I don't think Jerome Powell is smarter than what the market is. So that's what the market's saying right now.
All right. So you mentioned this, that the Fed is still hoping for a soft landing. Powell says maybe a recession won't happen, but then if you look at the statistics, specifically, if you look at the consumer confidence index that came out yesterday, the expectations index is now below 80. And that's really key for economists as they're trying to predict when this recession is going to hit, if it maybe already is here and it's just mild. When that expectations index drops below 80, that's typically a signal over the past that a recession is going to happen within the next year. Again, some argue that we may already be in a recession. Some say it's coming within the next 6 months, sometime in this quarter. When you're trying to look at this as a trader, what are your thoughts on the whole recession story and whether or not it will happen?
Sure. So the big R word, right? Recession. Everyone uses that word as if all recessions are created equal, and they're definitely not. Like it's, recessions are this big scary thing. And obviously, no one wants us to go in a recession. We don't want people to lose jobs, but not all recessions are created equal. You can have severe recessions and you can have mild ones. I have made the argument that we've actually been in a very mild recession for quite some time. Once upon a time, I studied economics at NYU. It's where I got my bachelor's degree. And I'm pretty sure I had on an exam, the definition of a recession is 2 declining quarters of GDP in a row. We had that already. But I guess that's not the official definition of recession anymore. It's some board out there has to decide that we're officially in a recession. So I would make the argument that we are already in a mild one. Could that one get worse? Could it continue? It certainly could. A lot of that, I think, is going to depend on what the jobs market looks like. So, right now with the jobs market, the market is loving when those numbers come in weak. Like we saw that employment cost index come in light yesterday and the market ripped higher on it as just an example. So people are making less money, so the market goes up. And again, you might be like, wow, that doesn't make any sense, but it does when you think about one of the biggest things that the Fed is worried about when it comes to inflation is people making too much money and wage spirals and all that, which another thing Jerome Powell said today was he's not seeing any indication of a wage spiral. So, I mean, we'll see how that all plays out. But the other thing I need to think about, because I'm a trader, is not only are we going to go into a recession? What is that recession going to look like? But more importantly, what does it mean for the market? So what we've seen historically is that we know that the market's a forward-looking mechanism. It looks to the future. And maybe one of the biggest arguments that you could make that's bullish for the market right now is that the market's already looking past the first half of 2023, because everyone is expecting this deterioration in 2023. All the sell-side analysts are expecting the market the S&P to go down to, 3,100 or 3,200 as EPS, as earnings specifically continue to decline. And that can happen without the market going down. Again, historically, what we see is that the market typically bottoms like somewhere 6 to 12 months, 6 to 9 months before the bottom of the economy in a recession. And it's pretty much the same statistic with like the earnings that companies are producing. The market typically bottoms like 6 to 8 months or 6 to 9 months before earnings have bottomed. So when I'm looking at the market right now that put in its bottom in October, maybe we are still another 2, 4, or even 6 months away from like the bottom of the economy or the bottom of earnings, but doesn't necessarily mean that this market has to go down. So that's the big thing that I'm wrapping my head around. And especially when you look at how we finally were able to break this big picture downtrend that we've been in for over a year.
Yeah.
Like I said, assume the market's right. Let's just assume that the market's going to be right.
Yeah. Okay. So the other big story this week, we obviously know jobs data is coming, but you kind of already touched on that. So in the chat here in the live event, I'm seeing people want to talk about earnings. So let's talk about earnings, because this is a big week for earnings. We've already gotten AMD. We got Meta this afternoon. We get Apple, Amazon, Google tomorrow. It's a big week, big for big tech specifically, which is where we've actually already seen the weakening of the labor market happening specifically in tech. So it's a big week of earnings so far. As I mentioned, more big names are still to come. We got 2 more trading days. This is a midweek check-in. So 2 more trading days this week. A lot happening tomorrow specifically. So is there anything particular that you're watching over the next 2 days, and what's your strategy going into any of those earnings?
Sure. So Apple, Amazon, Google tomorrow are huge. I currently have positions in all 3 of them. I most likely, don't want to say with 100% certainty because I don't know what the future will hold. I most likely will be holding at least something on those names into those reports. We already saw a Microsoft report, which initially sold off and now is above where it was. And we just had Meta come out after hours that last I saw before we started our conversation was up like 21% from yesterday's close. Solid looking numbers. And then the big thing was that they added an additional $40 billion on their buyback. I was just having a conversation with my team about this. These companies, a lot of analysts have gotten really bearish at the end of 2022 and the beginning of 2023 on these mega cap companies. But where they are now, some of them are almost like value stocks. And I actually think that they just rotated Amazon and maybe Microsoft into like the S&P value index, which is kind of mind blowing when you think about what these companies are. And it's just the sheer amount of cash that these companies are able to bring in, that they're able to return to shareholders through buybacks and dividends. In my brain, they're like almost unstoppable, and big dips in them are always something that you want to potentially consider buying if the risk is appropriate to you. And we just saw it right now. I mean, these companies buying back their own stock at $40 billion a clip, what Meta just announced. Do you really want to fight that and be on the short side of the market with those types of names? And then when you think about how the S&P and the NASDAQ are constructed because they're market cap weighted, well, at the end of the day, it's going to be that buyback in Apple that is like helping to keep at least a degree of a constant bid underneath the market to a certain point. So Yeah, it's going to be an interesting one. Some other interesting statistics that I've been looking at, and we saw this with with Microsoft. Microsoft's report really wasn't very good, and it was coupled with some really negative language from Satya Nadella, and they brought the whole thing all the way up. I was looking at some statistics that basically showed, and this is actually what my team and I were expecting coming into this earnings season, that companies this earnings season are missing at a much higher percentage than they typically do. And I can't quote what the exact numbers are, but it's something like 75, 77% of companies typically beat on EPS. And this earnings season, it's been in the mid 50s or something like that. That's actually been beating. But so a lot of those sell side analysts are right. The earnings expectations were too high. Way more companies are missing than they usually are. But the other interesting piece of data that I saw is that I believe this earnings season, companies that are missing on earnings are performing better than any other, as an aggregate whole, than any other earnings season in history, which that was like kind of mind blowing. We saw something a little bit similar back in July 2022, when the economists and everybody was also getting super bearish and had very low expectations coming into that earnings season, where companies that reported in line actually perform much better than they typically do. So what I've been telling my team is that it's not just how the company is performing versus earnings expectations. It's actually how these companies are reporting versus the expectations of the earnings expectations. It's like a whole nother layer of thinking there, because everyone coming into this earnings season already was expecting all these companies to miss. And if everybody's already expecting it, then it happens. Is there really a downside surprise on that? And the market's telling us no. And they're doing that with their buy votes, coming back in and buying back stocks like Microsoft or Intel, which still finished negative on its report. That was one of the worst reports I've ever seen. That Intel report that came out a couple of days ago, and they still bid the stock up a good percentage off of its lows. So it's been a really interesting market environment, and this is why I love what I do.
Yeah, I want to talk a little bit more about earnings and all of that. So really big going into this earnings season, as you mentioned, everyone knew the misses were there. That was kind of like a given, etc. A lot of the focus is on guidance, and the market is looking at these companies, these maybe the mega caps, but also smaller companies, to get a gauge on at least certain sectors of the economy, what might be expected, to maybe gauge if we could be in a recession or not now or in the future. So do you think any guidance that we've gotten so far has been helpful in gauging that? And then if you're looking at that yourself as a trader, how are you interpreting guidance for yourself, or the decision to not provide guidance like many companies are now doing?
Sure. So guidance always seems to be more important than whether or not a company actually beats on their their past, as far as like EPS and revenue. It's always about how they're guiding for the future. So that's typically the more important statistic to pay attention to when these earnings reports are coming out. And that's been another one where it's the expectations of expectations that we really need to be paying attention to, because we've had these companies not provide necessarily the greatest guidance in the world. And I mean, EA just got destroyed last night on like one of the worst guides I've ever seen. But generally, the market is treating misses on guidance or inline guidance pretty well this earnings season. So I really kind of just look at it on a case by case basis. I haven't seen any broader trends outside of the semiconductor space I was paying close attention to with Intel versus AMD, because Intel got destroyed and the numbers were horrible. In hindsight, both with and with forward-looking numbers that they provided for guidance. But the reason why is because AMD and NVIDIA are eating their lunch. And then when we saw AMD come out last night, AMD was able to trade higher on decent numbers. So really kind of just taking that on a case-by-case basis, and very curious to see what actually happens tomorrow with the guides from Amazon, Apple, and Google. And the final thing I would say about companies choosing to not provide guidance, that became a big thing during COVID. More and more companies seem like they are beginning to provide guidance again, which I do think is important. Prior to COVID, if you didn't provide guidance, the market would decimate you for that. Like,
Mm-hmm.
oh, something is seriously wrong with this company if they're not providing guidance. And now during COVID and a little bit after COVID, they've given a lot of companies a pass. I mean, even Apple wasn't providing guidance for a while. They gave a lot of these companies a pass, but I think we're getting past COVID enough where you don't get a pass on not providing guidance anymore. We're seeing more companies do it, and you really need to. And there's no excuse not to unless you have something seriously wrong with your business and you just can't even create the guidance that's necessary.
Yeah. Okay. So real quickly for everyone viewing, I want to let you all know the chat is available. And if you have a specific question for Derrick, please put it in the chat. I will ask him. We will talk about it. We have a few more questions left on my end, but I want to open that up for everyone so we can talk about what you guys want to hear about from this professional trader. Okay. So Derrick, you've mentioned that this has been a great week of trading for you. Really, January was a great month of trading for you. So far, 2023 has been a great year of trading for you. But I want you to tell me about the worst trade you've had this week. What made it go wrong? Was it the loss? Was it that you traded it badly? You just didn't follow your strategy? Tell me all about it.
Sure. So we really want to think about what a bad trade is. And, I just want to throw that out there first. A bad trade is not a trade where you lost money. A bad trade is where you made a mistake. It's where you deviated from your plan. It's where you didn't follow your money management rules, where you didn't follow your risk management rules. If you are a trader, you work in a game of probabilities. That means that if you do everything right, you will have trades that work and you will have trades that won't work. You'll have gains and you'll have losses. And as a matter of fact, if you do everything wrong, you'll still have trades that probably make you money. You did the wrong thing and, probability, you just got a little lucky, even though I don't ever like to blame luck when it comes to trading. So P&L does not necessarily dictate good trades or bad trades. Having a game plan and following your game plan and following your rules is what does. So for me personally, I only have a bad trade, whether I made money or lost money, if I violated a rule, if I got into something that I shouldn't have been involved in. And I have had, a couple of trades that were losers over the course of this week, but I would genuinely say to you that I don't think I've had a bad trade this week, which doesn't mean that I don't make mistakes. Again, I always want to keep it fair and balanced. I have made more than my share of trading mistakes over the years. There have been times where I have violated my rules that I have just absolutely beaten myself up about it. I would actually say that one of the biggest progressions I've made over the course of a 13-year trading career is how much less frequent that happens, to the point where I keep track of it in a spreadsheet. If I did something wrong at the end of the day, that trade goes into the spreadsheet. And I actually, just this past weekend for the year 2022, I add up all potential lost P&L from every mistake that I made throughout the year. And I'll say to myself, your stupidity cost you whatever the number is, $10,000 over the course of that last calendar year. So don't do that anymore. and again, I don't think I've made a single one of those mistakes this week or possibly even this year at this point.
Okay. So, that's a big lesson for anyone watching who may be wondering, how you approach things is that, hey, a bad trade is not necessarily one where you lost money. It's one where you didn't follow your plan. You didn't follow your strategy. You traded wrong. Money loss doesn't matter. Okay. So I do have a question here from a viewer, and he wants to know about housing stocks. They've already declined significantly this year. We have seen a really big pullback in the price of housing stocks. But if you look at the housing market, there hasn't been as much of a big decline in home values. He says that there seems to be kind of a dislocation in the market. Tell me what you think about that, why that may be. Is it just home values waiting to catch up? What do you think?
Sure. So I'm looking at the chart of Lennar right now, which I'm seeing is also, kind of continuing to make highs here and is looking pretty bullish. I don't like to trade the home builders personally. I find the stocks to be very tricky to trade. So I don't follow them extremely closely. And I also don't think that the home builders necessarily as stocks have a lot to do with the housing market. When you think about, what percentage of the housing market in the United States is comprised of new builds. I don't know what that percentage is, but I know that it's very, very low. So I don't think that you can look at home builder stocks and have a good gauge on the direction of the economy or the direction of the housing portion of the economy kind of based on that. And that would really be the extent of my commentary on it.
Okay. Our next question is about the prices of goods and services during a recession. So how prices of goods and services are affected during a recession, and then what the Fed will do about it.
How prices of goods and services are affected during a recession. So, well, the Fed is trying to drive prices down, right? They're actively trying to do that. And the best way to drive prices down is to create a recession. And that's one of the reasons why they're paying so much attention to how much money people are making. That's what we were saying earlier about, like, isn't this a crazy world we live in where when we get an economic number that less people are working, or that the people are working or are making less money than what was expected, that the market's able to go up. And that's because in order to drive inflation down, you want people to have less money so that they're spending less on things. Then what inherently has to happen is you start getting inventory builds from Target or Costco or whatever. Their inventory begins to build up because no one's buying. If their inventory is building up, and the last thing that you want if you're Macy's is to be sitting with a bunch of 2022's fashion when it's 2023, right? What are you going to do with all those goods? So you end up heavily discounting those goods. And when you discount those goods, prices come down, inflation comes down. And that's what we're really seeing on the good side of the economy already. And that goes back to what we were saying with Jerome Powell, that he's starting to see disinflation in goods. That's what we're seeing. Inventories are building up, supply chains are opening. Companies are forced to cut prices and give these better deals because otherwise people aren't going to come in and buy those goods. Services has been a little bit stickier. It's been a little bit trickier. Most of the continued wage inflation has been towards services jobs. I think we saw yesterday, like the hospitality workers are still doing pretty well as far as
this morning from ADP, they were the strongest gain, up 95,000.
Right. So you got your hospitality workers that are still doing really well. That services. You've got housing is also part of services as well. When it comes to inflation, people forget about that. I think that is going to have a little bit of a lagging effect also. Eventually you're going to see people. So, I mean, we're starting to see right now, and the statistics are showing, and again, I don't have them off the top of my head, but we're starting to see higher percentages of people going back to living paycheck to paycheck. And if you're living paycheck to paycheck, as opposed to a year ago and you had a lot of disposable extra income, now all of a sudden, do you take that second vacation this year, or do you just stick to the one vacation? And you've got that less money. So you say, hey, I'm not going to take that second vacation. And that's, if it's you and a family of 4 or 5, that's 4 or 5 less people sitting on that airplane. And then you can begin to see the prices for flights potentially begin to come down. We don't seem like we're quite there yet, but that could be the next thing that gets lined up, and that's how it works.
Okay, so the next big piece of data that's still to come this week is the labor market's January jobs report Friday morning. Expectations from economists are that will show gain of 187,000 jobs last month, which would be a slowdown from December, and the unemployment rate is expected to tick a little bit higher to 3.6%. The Fed has openly said they want to see a weakening in the labor market. They need to see an increase in unemployment, and that's just because, as we've talked about, we need to see that weakening in pay and all of that to decrease demand, to lower prices. It's all connected. How are you approaching the January jobs report Friday morning?
For me, it's going to be entirely based on where the daily technicals are when we come into Friday morning. So the question is, where are we closing Thursday night? And I guess also what happens after hours with the earnings reports. My trading software, again, I'm a professional licensed prop trader through T3 Trading Group. I'm able to trade from 4 a.m. Eastern to 8 p.m. Eastern. On the day in which Apple reports earnings, it's not unusual that I'll be trading until 7, 8 o'clock Eastern. It's happened in the past. It might happen again tomorrow, where I'm just continuing to actively trade these stocks because they trade very liquid on those reports. So how I'm going to game plan for the jobs number really depends on where we're closing out with everything on Thursday. For me, it really is going to come back to the technicals. I can't tell you what that jobs number is going to be. I don't have a crystal ball. I have no idea. The market will react to those numbers either positively or negatively. Will go up or down. There's probably going to be some volatility. That's almost a sure thing that there will be some volatility, but there are no such things as sure things in the market. So whether I'm coming into that number with more long exposure, less long exposure, hedged or not hedged, is going to entirely depend on how extended or not extended the market is as of 8 p.m. Thursday night, which as of right now, the market is, like I said before, it's at that area where we're stretched enough where we usually need some time or price correction in the market in order to be able to get continuation. And that's why I actually began to hedge myself a little bit late this afternoon by shorting some TQQs. So that same thought process would just follow through on Friday, and then we'll see what happens with the number.
Okay. Our next viewer wants to hear about your trading mindset. So how do you deal with things like FOMO, entering a trade too early, exiting a trade too soon, hesitation, etc.? What do you tell yourself in the face of uncertainty?
Sure. So I have a lot of experience with this topic. Managing my emotions has always been my biggest weakness as a trader for my entire career. And I have gotten much better at that as I've gotten older and more mature. There's a big difference between me, how I would lose my cool and how I would trade as a result of losing my cool when I was in my 20s versus now when I'm in my mid, or dare I say late 30s. So there's been a big adjustment to that mindset over time as I've kind of matured a little bit, but I still lose my cool. I still get emotional. You should have saw my phone broke. The F-bombs and 4-letter words that I would not repeat during this conversation that were, coming out of my mouth at very high volumes might have scared the cows, down the street over here. I certainly still lose control of my emotions. The key is game planning. And that's been the key for me. Create a game plan, follow the game plan. If you already have a pre-established game plan for the trade that you're going into, your emotions don't matter. Do what you planned on doing and do not deviate from it. One of my favorite things to say about trading to people, the goal of being a professional trader is to be what we call consistently profitable, to make money 4 to 5 days a week or 9 out of 10 days, be consistently profitable. The only way that you can be consistently profitable in trading is to be consistent in regards with your actions to the market. Sounds very simple. Most people are not consistent with what they're doing. The only way that you can be consistent is to have rules. And then you have to have the discipline to follow those rules. And those rules are held within the game plan that you create on any and every trade before you enter it. So you're saying, okay, I want to potentially buy Apple or short Apple or whatever it is. You can't just blindly press the button and have no risk management or anything. You say to yourself, all right, why do I want to do that? What is the game plan that I'm going to create for myself if I'm right and the trade is working out and I can make money in order to maximize reward? And what is the game plan that I'm going to have if I'm wrong and the trade goes against me and I'm losing money? What do I do in any and every possible situation? That's your game plan, and it's rules-based. And then you follow it. It doesn't matter how angry you are that you just broke your phone, or how upset you are at your last trade, or what your P&L looks like at that point in time. If you have rules and you stick to them, it can breed consistency, and that can create consistent profitability for a trader.
Okay. Our next question is pretty specific here, but I'm going to ask you it. But just for our viewers, we are getting close to the end here. So if you have a specific question for Derrick, please put it in the chat. I will ask him. We will talk about it. So the next is, do you have feedback on the ability to effectively trade natural gas? Been lots of volatility there. There is typically high volatility, and there are 2-time ETFs available. So what are your opinions on natural gas and how the heck to trade it?
Yeah, nat gas has definitely been the topic du jour recently. I am friends with a few old, commodity pit traders, and what I learned is that they call nat gas the widow maker down on the pits. It's a very dangerous product to trade, especially if you're doing it with a leveraged ETF. I mean, where natural gas is trading right now is kind of mind blowing when you consider that we were coming into this winter and we were talking about how people were going to be freezing in their own homes in Europe because of the situation with Russia and Ukraine. And now what's nat gas off 75, 77, 78%, something like that from highs. It's pretty wild. So you don't want to be a bag holder on this nat gas. I'm not a commodities trader. I tend to, if I'm going to trade anything that's commodities related, I usually like to trade individual companies that their business will be based off of it. So like I've traded symbol AR as an example off of nat gas, or obviously you've got XLE related companies that you could be trading off of the price of crude. But then if you look at the XLE, it's actually performed much better than crude has. My general understanding of the commodities market is that it tends to be much more mean reverting than the equity market is. So usually what tends to happen over time is that rubber band to the downside or the upside will kind of snap back and you'll get mean reversion in commodities. I would expect the same thing in nat gas to occur, but you got to be careful. Like I said, they have that nickname for it on the commodity pits for a reason. And I was looking at nat gas. Like I said, I usually don't trade these products too often. I day traded Boyle, the leveraged ETF, just yesterday. Had a pop on some volume at 8 a.m. Eastern. I think I bought it a little bit off after that, like kind of off of that low. I ended up having a very small winner on it. I followed my game plan. I followed my risk management. I was able to book a little bit of profit. Then the trade came down, failed to stop me out. I did not go back to that well again today. I think I saw at one point nat gas was down like 7% or something. We're going to close down 8.5% nat gas today. So you just got to be careful, manage your risk, especially if you're doing those leverage ETF, because I do agree with the thought process that I know a lot of traders have right now, which is, oh my God, I can't believe that natural gas is so cheap. It has to go up. Nothing has to do anything. And one of my favorite sayings is that a market can remain irrational for longer than you can remain solvent. So maybe if you think this is a rational low price for nat gas, does anyone remember when crude went negative during COVID? Like it was completely insane.
They were begging people to buy oil.
begging. So, I would look for, and I would potentially expect a bounce in nat gas at some point in the future. I know a lot of smart people are, but you better make sure that you're managing your risk if you're getting involved in that, especially if you're doing it through any of the levered ETFs.
All right. Our next question is on game planning and how you do it. So do you use market positioning to help make daily decisions on your own game planning?
I assume by market positioning, you're meaning the positioning of the market, like where the S&P and where the NASDAQ and where the Russell are trading.
I would guess so, yeah.
And the answer is 10,000% yes. Okay. Even though I trade individual companies much more than I trade index ETFs, I do trade index ETFs also. Again, position disclosure, I'm short TQQQ right now, a little bit overnight. Yep. But the market itself is perhaps the most important layer of probability, and that's the term that I use with my team. All these different things that can affect a trade that you're involved in, we call those layers of probability. The market is possibly the most important one. If you're looking to go along a stock and the market's moving higher, then you're going to have a much higher probability of success than you would otherwise, pretty simply put. So I take a top-down approach to technical analysis with my own trading. When I do the team morning meeting and the team afternoon meeting every day, I always start with the S&P, the NASDAQ, and the Russell. Once in a while, maybe I'll look at the Dow. I don't really care too much about the Dow. Yeah. It's a constant analysis of the S&P, the NASDAQ, the Russell. We've consistently seen over the course of the last year plus now that the Russell's been the big market leader. If the SPYs and Qs have been looking good and the IWM is not, usually the SPYs and Qs have been failing down and the IWM leads lower. And the opposite's been true, including even recently with this most recent market rally that we had off those December lows through January. The Russell was that real initial leader, and then we had a little mean reversion with the Qs catching up in the second half of the month. So that's the starting point for everything. I don't think you can be a trader without having at least a chart of the SPY or the S&P on your screens at all times.
Okay, and then a follow-up to an earlier question is that, can we say a recession is good for people because prices of goods will go down? And then also, what trading advice do you have for entry-level traders? So those two questions there.
I don't think that a recession is necessarily ever good for people,
Okay.
because at least historically, and maybe this recession is so mild that it's different, but I don't know. I don't know if up until this potential recession, and this could still change, if there has ever been a recession that wasn't coupled with some pretty serious layoffs.
Could we just say that a recession is maybe because of how high inflation got, it's this necessary evil kind of that we have to get back to that level ground that the Fed is looking for?
I think that's very fair. I think that's very fair. It's a necessary evil that we need in the same way Volcker, in the end of the 1970s, early 1980s, created a recession. I wasn't alive. I'm getting a little older, but I wasn't alive.
Read all about it
in the late 70s. I've also read all about it. My understanding is that we look back at Fed Chairman Volcker as a hero. Right, he's a hero because he was the person that was able to tame inflation when no one else had the tenacity to do it. But my understanding is at the time he was not very well liked for the actions that he was taking.
Well, I feel like we need to remember that the Fed's goal is not to completely get inflation down to zero. Inflation is a natural part of a developing economy or an expanding economy that will continue to expand. But inflation needs to be at a healthy point of, that around 2% that the Fed has deemed to be healthy. And the Fed's dealing with inflation. They're dealing with this hot labor market. And the labor market is this lagging response to their efforts against inflation. So it's complicated. It's complicated for everyone involved, traders, people who have jobs, the Fed, everyone.
We certainly don't want a Zimbabwe currency crisis on our hands here in the United States. So I think that the way you described it, Greta, as a recession in this type of circumstances is necessary evil is probably the best way to think about it.
Okay. And then her other question was also, what trading advice do you have for entry-level traders in this market?
Sure. Risk management, first and foremost. You need to create rules for risk management, and you need to have the utmost discipline in how you follow them. Most entry-level traders, when they're first getting started in the business, do not make money. Almost all entry-level traders, when they first get started in the business, do not make money based on what I have seen. And that is no matter how smart you are, what your educational background is, or how good of tutors you are that you are kind of working with. So the key is you need to go through a very large, very steep learning curve when you're getting involved in this business. You don't even know what you don't know. And the only way that you're going to be able to get through that and come out on the other end is if you manage your risk well enough when you were first getting started that you didn't dig yourself into a hole that you can't climb out of. So first and foremost would be create rules for risk management and money management, follow them with the utmost discipline. And then the second thing would really genuinely be get involved with the right team. And the T3, the folks over at T3 Live, doesn't necessarily have to be my community or the team that I'm managing. I might not be right for everyone necessarily, but get involved with a place where you can pay your tuition not entirely to the market so that you can get through the learning curve faster than you would otherwise. And then the final thing I would say, and this probably echoes my friend Scott Ruther a little bit, is you got to work hard. You got to work hard. This is not, a lot of people who got started trading in 2020 or 2021 thought that this was like, I can devote 30 minutes to this and become a billionaire. It is not that way. And if you're only working from 9:30 to 4, it's not enough. I have made my biggest strides as a trader outside of the hours of 9:30 to 4. Reviewing the work that I've been doing, playing around with Excel spreadsheets, playing around with game plans on weekends when the market's closed. This for pretty much my entire career has been a 7-day-a-week business, even though the market's only open for 5. And I, to this day, I work 11 to 13 hours a day. And part of that goes towards my other responsibilities, with business development for T3 Trading Group and things like that. But, most of it goes towards my trading and managing my team. And that's the amount of time it takes. It takes me, I do a team morning meeting every single day at 9 a.m. Eastern. I begin my research process for that 2.5, 3 hours ahead of time. So I'm doing 2.5, 3 hours of research and work and game planning and thought processes, all leading up to doing the morning meeting that I do every day at 9 a.m. when I then share all of my thought processes and all of the information that I've kind of gathered and the game plans that I'm planning on potentially utilizing for that trading session. So yeah, get involved with the team.
Mm-hmm. Yeah. Okay. So our next question is, what is your thought process in a drawdown? How do you alleviate confidence or discipline issues? And how do you get yourself back to where you need to be?
Sure. Drawdowns are really difficult. They're also a natural part of the business. If you speak to anybody who's been trading for as long as I have, and they tell you that all they've ever known is sunshine and rainbows, and they've never, dealt with a slump in their trading career or an extended period of losses, that person is probably lying to you, and you should run in the other direction. I've been there. I've had my downturns. I've had my difficult periods of time. Believe me. One of the first things you need to do is to assess why. So I have found that for most experienced traders who all of a sudden are not performing well, the typical culprit is a change of market environments. You had a specific set of strategies that you've been utilizing. They've been paying you very well. I mean, how many people have I spoken to over the years who are super successful traders when the market traded in fractions and then couldn't trade anymore when the market went to trading in pennies? There was a lot of people out there that were like that, and they just unfortunately failed to adjust that new normal of the market. And that happens a lot. I've seen many different market environments. We had 2019, where I don't remember how much the S&P was up on the year, maybe 20, 30%, but I do know that the biggest drawdown, I think, on the entire calendar year was like 1.7%. The entire calendar year from highs to lows, the biggest drawdown was like not even 2%. Look at 2022.
Yeah.
Every day we were up or down more than 2%. You think you can take the exact same strategies you were using in 2019 and use them in 2022 and expect to have the same results? You're not going to have the same results, most likely. So the biggest thing that you want to first try to recognize is the why behind the difficulties that you've been in. What has changed? I remember my first big slump as a trader was like late 2022, early 2022, late 2012, early 2013. So we're talking, 10 plus years ago. This was like my first major slump, and the market environment changed. I had a specific strategy I developed. It was primarily to the short side. It was exclusively day trading. It was based off volatility coming in while being short, and the market environment just changed. It just wasn't working anymore. I was taking losses. That's actually when T3 has been the most important to me. I turned to other seasoned traders at the company and I said, hey, look, I know you're trading Microsoft and I'm trading Microsoft. I'm just not having the results anymore. What are you doing? And it was getting their feedback enabled me to entirely change my strategy. I increased my hold time. I went from being short to being long and was able to find a degree of success again over time. So you got to figure out what changed and what you're adjusting to do about it. And then the next thing would be you got to trade small. And that's the hardest thing. The hardest thing is sizing back down when you've reached a certain point of success, because you're trying out new strategies and seeing how they work in the market environment. If you went from making and losing tens of thousands of dollars every single day, and now you're just losing money every single day, you need to almost size that number down to hundreds of dollars a day, as opposed to thousands of dollars a day. Let the results come to you. You might be in a little bit of hole because you just took these losses in a bunch of times in a row, and now you're like, oh man, I was just losing $5,000 a day, and now I'm having a good day where I make 500. But it doesn't matter. It's about the process and getting the consistency.
Right.
Back.
You don't want to try to make back the money as quickly as you lose the money. You want to make back the money
the worst thing you can do is think about, the worst thing you can do is think about having to make the money back. You will most likely, from experience, only dig yourself into a deeper losses if you stay as big when you don't know what you're doing. So you almost have to trade where the numbers almost feel inconsequential, but you have to remember that they are consequential, because if the consistency comes back, then you add the scale, and then when the scale is there, you're doing things right again. So
okay. I think this next question is a good one where we can end on. We saw 2020, 2021, as you mentioned, where was this great market. You could basically just throw your money in the market and you'll probably win. 2022 was a bear market, and probably the first bear market for a lot of traders who got started in 2020, 2021. They've never experienced drawdowns like this. What advice can you offer to a trader about managing risk in the volatile market that we're currently seeing?
Sure.
I mean, today, if you want to talk about volatile, today.
Yep.
This is like a prime example.
Yeah, seriously. I'm going to start actually by saying something that I think a lot of people have disagreed with, where I actually don't think 2022 was an extremely difficult year. I think I've actually seen more difficult years than 2022 was. It was just different. It wasn't easy. I'm not going to say it was easy. It was not easy, but I don't think it was an extremely difficult year because we had good movement. And
it was difficult, I'd say. Well, okay, for you, I don't think it was maybe difficult because you know how to adjust your strategy to changing market environments, right? But for someone who maybe came in 2021 and hadn't learned how to trade a market like 2022, learning how to adjust their strategy and do it right was probably really difficult.
It was difficult if all you've known in your trading career is 2021.
Yeah.
2021 is not a normal year.
No.
Like that's not how things normally are. 2022 probably isn't a normal year either because there's been so much increased volatility, but volatility creates opportunity. But the biggest thing about that volatility, honestly, what I want is like a happy balance of volatility. I don't want 2019 where we had zero volatility. 2022 was maybe a little bit too extreme because it does become difficult from a risk perspective. I kind of want, somewhere in the middle of that, where I can get the movement that can make me money, but I don't have to worry about, like, one thing about 2022 is it's a very unforgiving market. If you made a mistake, like you didn't obey your stop loss, oh boy, you could lose a lot of money in a short period of time because of that. But again, that volatility also creates opportunity. One of the bigger things about when volatility increases is that you want to trade with less size and more space risk. So you might have gotten used to trading a certain amount of shares, right? You take 2,000 shares in an average position or whatever, and all of a sudden when the volatility increases, you're taking that same 2,000 shares, the P&L swings become dramatically different. I personally had like an average buying power that I was using in the market at a much lower rate in 2022 than I had in previous years. Yet my P&L swings were as big, if not bigger, honestly bigger in 2022, using less money. That's because of the volatility. So when you're thinking about how much you're risking in the trade, the amount of shares you take is supposed to be the last part of the equation. The first thing you need to know is, well, here's where I'm buying, here's where my stop loss is. This is how much, I call it space risk between my entry point and my out. The next thing is, how many dollars do I want to risk? So just to use simple math, right? If it's 10 cents worth of space risk in a cheap stock and you wanted to risk $100, you would take 1,000 shares. Well, as volatility increases, that same trade, instead of it being 10 cents with 1,000 shares for $100 worth of risk, it now maybe is 25 cents worth of risk, and you're taking 400 shares to have the same dollar risk. So again, first you think about your space risk. Okay, I know I need to risk 25 cents in this to trade it appropriately. I want to risk how many dollars in this trade? Maybe it's $100. And then, okay, based on that, those two pieces of information, I can take this amount of shares. That's the way to think about it. And that's the biggest adjustment you need to make, I think, when volatility increases. And it becomes, like I was saying before, even more important to be disciplined with risk management and money management, because in 2021, if a stock went down and you didn't obey your stop loss, the stock probably went right back up and you got rewarded for making a mistake and made a bunch of money on it. In 2022, if you didn't obey your stop loss, that stock went down, and then it went down some more, and then it went down more than you could believe, and then it went down more than you could fathom, and then you were broke. So you got to make sure that you're obeying your risk management there.
Okay, I know I said that might be our last question, but one came in that I think is going to be a great ending for people just to know who you are and what you're doing this year. So what is the next step that you, Derrick, want to achieve this year, whether it be in trading or personally? Tell us.
Sure. So feel like I have a groove with my trading right now where I know what my game plans are and where my risk is on them. And I really just want to have 2023 in some ways be a continuation of what I was able to do in 2022 as far as kind of sticking to the rules. So the biggest thing there is really just the continuation with my own trading. So probably the bigger goal for me is to further expand the team that I'm working with in a positive way. And there are two major ways to accomplish that. I want traders that are trading with me through T3 Trading Group at my side. We have fantastic prop and retail account offerings that people can participate in. I want two types of people though on my team that I'm working with. I want the entry level trader who is hungry and willing to grow and will at first be what I call a taker, meaning a person who is primarily taking the information that my team and I are providing, as opposed to giving information that is useful. That's part of their learning process. So they start as a taker, they learn and they learn and they learn, and eventually they cross that bridge where they then become a giver, where they're the ones who are able to contribute really good information and really good ideas that expand the team. That's one. And two is continuing to onboard and work with more experienced, successful traders who are working with 6, 7, 8-figure accounts, who already know what their edges in the market have. And for them, it's going to be both a give and a take, where they're going to have a lot of information that they're going to be able to provide to the team that's going to help, honestly, me and my team make money with our trading. And at the same time, they are receiving a lot of information from me and my team that I believe could help add to their edge and make them more money. So that's really what I want to do. That's my biggest goal, is to expand this team. And I'm trying to do that through a number of ways. Working with both T3 Trading Group and its sister company, separate but affiliated company, T3 Live, the YouTube channel that I've started. For everyone who is watching, if you don't subscribe to it, look up Derrick the Trader on YouTube, hit that subscribe button, follow along with that, and become part of the virtual trading floor that I'm running. There's a number of ways you can do it, which is called the Pro Desk Virtual Trading Floor, and be one of those people. Again, if you're more entry level now and you're starting as a taker and you're going to ask a lot of questions, that's fine. We're happy with that. But eventually you're going to have that goal of also being a giver. And then same thing. If you're an experienced trader that's out there, I'm so proud of how my team has developed over the years. I've been working on building the team that I'm working with for 10 years. I started my trading desk at T3 Trading Group in 2013, the beginning of 2013. So I'm at the 10-year anniversary here with that team. And the way that it's evolved over the years, the institutional approach that we're taking, the type of information that we're getting in there, I'm still learning. I'm learning from members of my team about topics that I didn't even know exist even 5 years ago as a trader. I'm learning about, gamma and gex and all these crazy things, and, how the options market is affecting, trading and zero DTE stuff. And I'm learning about all that now. It's this great give and take of high level professional information, where I think that if you are a serious trader working with real money, that you will get a lot out of it. So get involved.
Yeah, if you're looking for a community, Derrick has one for you. Thank you so much, Derrick, for joining me for this first edition of Conversations with a Pro Trader. For everyone watching, we'll be back in 2 weeks on February 15th with Derrick's counterpart in the virtual trading floor, his teammate, Patrick Haw. He's going to be joining us to talk about whatever happens in his trading in 2 weeks from now. So thank you again, Derrick, for joining us. And thank you to everyone for watching. We'll see you in 2 weeks.
My pleasure to be here.